Imagine waking up one morning and realizing that the same ounce of silver you can buy in America for $108 is being sold in China for $136. That's a $28 difference for the exact same metal, and most people have no idea why it exists. This gap is not an accident, and it is not temporary. It is a sign that something deeper is happening inside the global financial system. Today, on the Gray Ledger, we are uncovering the hidden story behind the silver price war. And before we go any further, take a second to like this video and subscribe to the channel, because what you are about to hear could completely change how you look at precious metals. Silver is not just a shiny metal used for jewelry or coins. It is a critical resource for modern civilization. It powers smartphones, solar panels, medical equipment, and military technology. Every day, millions of devices depend on tiny amounts of silver to function. And when demand for silver rises, the entire world feels the pressure. In the United States, silver prices are mostly controlled by large futures markets like COMEX. These markets trade massive paper contracts that represent silver, even when no physical metal is moved. The system keeps prices relatively stable and predictable. Traders buy and sell based on expectations, not always on real supply. But China operates in a very different way. There, physical silver matters far more than paper contracts. Investors, factories, and institutions want real metal in their hands. They are willing to pay extra just to make sure they get it. This is one of the first reasons why prices are higher in China. In China, silver is seen as both an industrial weapon and a financial shield. Factories need it to keep production running. Families buy it to protect their savings. And the government watches it as a strategic resource. When so many powerful players want the same metal, prices naturally rise. Meanwhile, American investors are more focused on trading than storing. Many people own silver on paper without ever touching it. This creates the illusion of abundance. It looks like there is plenty of silver available even when physical supplies are tightening. That illusion keeps prices lower in the US market. Another major difference is government control. China tightly regulates how silver enters and moves inside the country. Imports are monitored, licenses are required, taxes and fees are added. Every step makes silver more expensive before it reaches the buyer. These extra costs are built directly into the final price. In America, regulations exist, but the market is far more open. Silver can move freely between dealers, vaults, and investors. Less friction means lower prices. Now, let's talk about demand. China is the world's largest manufacturer of electronics and solar panels. Both industries consume enormous amounts of silver. Every new factory increases pressure on supply. Every new technology increases demand, and this demand does not slow down. It grows year after year. When supply struggles to keep up, buyers start competing. Competition drives prices higher. That competition is happening right now inside China. At the same time, many Chinese investors distrust traditional banks. They prefer holding physical assets. Silver is easy to store, easy to verify, and easy to sell. That makes it extremely attractive during uncertain times. When fear enters the economy, silver demand explodes. More demand means higher premiums. More premiums mean higher prices. Now compare that to the United States. Most Americans keep their wealth in stocks, bonds, and retirement accounts. Fewer people rush to buy physical metals during stress. This keeps sudden demand spikes under control, and that helps stabilize prices. Another hidden factor is transportation. Moving silver across oceans is expensive and risky. It requires security, insurance, and special handling. These costs can add several dollars per ounce. By the time silver reaches Chinese buyers, the price is already inflated. Arbitrage traders see the price gap and think it is free money. But once they calculate shipping, taxes, delays, and risks, most profits disappear. That is why the gap does not close easily. It stays in place like a pressure valve. There is also a psychological factor at work. When people believe something is scarce, they pay more for it. In China, silver is often perceived as limited. That perception fuels aggressive buying. Aggressive buying pushes prices even higher. In the US, silver feels abundant. Stores are full, ETFs are liquid, futures contracts are everywhere. This creates confidence. Confidence reduces panic. Reduced panic keeps prices lower. All these forces are slowly building pressure inside the global silver market. And as this pressure increases, the gap between China and America becomes impossible to ignore. Now, to really understand why this price difference stays so strong, we need to follow the journey of silver from the mine to the buyer. Silver does not move freely like ordinary products. Every shipment is treated as a high-risk, high-security operation. Armed transport, sealed containers, and heavy insurance are standard requirements. Each layer adds cost before the metal even reaches a port. These costs quietly build up in the background. By the time silver reaches Asia, its price has already climbed. Then comes customs and inspection. Every shipment must pass detailed verification. Documents are checked, origins are confirmed, and purity is tested. Even a small mistake can delay delivery for weeks. During these delays, prices can change dramatically. To protect themselves, sellers raise their margins. Buyers end up paying for that uncertainty. Storage is another major issue. In China, high-security vault space is limited and expensive. Demand for storage continues to grow every year. When space becomes scarce, fees rise. These fees are built into retail prices. In the United States, storage systems are larger and cheaper. Competition between vault providers keeps costs low. Lower storage costs help stabilize prices. Liquidity also shapes the market. In America, silver can be bought or sold within minutes. Digital platforms and dealer networks operate nonstop. Investors rarely struggle to find buyers. In China, physical trading takes longer. Verification, approvals, and settlement slow the process. Slow transactions increase financial risk, and higher risk always leads to higher prices. Currency exchange adds another invisible burden. Chinese buyers must convert yuan into dollars for imports. When the yuan weakens, silver instantly becomes more expensive. Even small currency changes affect bulk purchases. These fluctuations are reflected in local premiums. U.S. buyers avoid this problem completely. Their market operates directly in dollars. This gives them a built-in advantage. Now consider industrial demand contracts. Many Chinese factories sign long-term silver agreements. These contracts lock in large volumes at premium prices. Companies keep buying even when prices rise. This creates constant upward pressure. American manufacturers use hedging and flexible sourcing. They can adjust faster to market changes. This flexibility reduces long-term cost pressure. Government oversight plays a critical role. Authorities closely monitor precious metal flows. Import limits and policy shifts can happen suddenly. When restrictions tighten, panic buying begins. Buyers rush to secure supply. Prices jump almost overnight. In the U.S., regulatory changes are usually gradual. Markets have time to adapt. Sudden shocks are less common. Stability keeps prices balanced. Trust in sellers is another factor. Chinese investors prefer officially approved dealers. These dealers charge higher service fees. Buyers accept these fees for safety. In America, dealer competition is intense. Lower margins benefit customers. Prices remain more competitive. Counterfeit risk also influences behavior. Fake metals damage trust in some markets. To avoid risk, buyers choose premium sources. Premium sources mean higher prices. Fear quietly pushes the market upward. Market transparency is also different. U.S. pricing data is public and instant. Everyone sees the same numbers. This limits extreme distortions. In China, prices vary by region. Some cities face shortages while others do not. Local scarcity creates local premiums. Over time, these premiums spread nationwide. This lifts the average price. All these forces work together. Logistics, currency, policy, storage, and psychology form a barrier. That barrier prevents prices from equalizing. Even when global prices fall, domestic premiums remain. Scarcity becomes part of the system. Competition becomes permanent. The gap becomes self-sustaining. And this is why the difference between China and America refuses to disappear. As these structural forces continue shaping prices, another hidden layer quietly controls the market from behind the scenes. This layer is made up of financial institutions, large traders, and global supply agreements. In the United States, massive banks and hedge funds dominate silver futures trading. They control enormous paper positions that influence short-term prices. These contracts represent silver that often does not physically exist. The system increases liquidity but weakens the connection to real supply. When paper trading expands faster than physical production, prices can stay artificially low. This is one reason American silver looks cheap compared to China. In China, paper trading plays a much smaller role. Physical delivery matters far more than digital contracts. Buyers want bars, not promises. This keeps Chinese prices closely tied to real-world shortages. Another important factor is inventory management. Large institutions stockpile silver in strategic locations. These reserves are used to stabilize domestic supply. When inventories shrink, prices rise immediately. In China, inventory data is limited and often delayed. This uncertainty encourages buyers to pay higher premiums. In the U.S., warehouse data is updated regularly. Transparency reduces fear-driven buying. Corporate hedging also plays a major role. American companies frequently hedge future silver needs. This protects them from sudden price spikes. Chinese companies hedge less and rely more on direct purchases. This exposes them to immediate market pressure. To avoid disruption, they accept higher prices. Media influence adds another subtle force. Reports of shortages spread rapidly through social platforms. Even small rumors can trigger buying waves. In China, these waves are amplified by tight supply channels. Prices can jump before facts are verified. This behavior strengthens the premium culture. In the U.S., institutional analysis slows emotional reactions. Professional traders evaluate data before acting. This reduces extreme price movements. Another hidden influence is national reserve strategy. Governments quietly monitor critical resources. Silver is considered essential for technology and defense. China prioritizes domestic availability. This policy encourages long-term accumulation. Accumulation removes metal from open markets. Reduced availability increases prices. The U.S. relies more on market forces. Strategic intervention is less frequent. This keeps pricing more flexible. Labor and environmental regulations also impact supply. Mining operations face stricter rules worldwide. Compliance increases production costs. These costs are reflected faster in China than in America. Producers often pass expenses to Asian buyers first. Technology trends further intensify pressure. Electric vehicles, renewable grids, and data centers all require silver. China leads global expansion in these sectors. This creates long-term structural demand. Demand outpaces new mining projects. Supply struggles to respond quickly. This imbalance favors higher premiums. Investment behavior also differs culturally. Chinese households favor tangible assets. Physical ownership provides psychological security. American investors prefer diversified portfolios. Stocks and funds dominate their strategies. This limits retail pressure on silver. Speculation cycles further reinforce differences. When prices rise, Chinese buyers rush in. Fear of missing out accelerates demand. In the U.S., profit-taking appears earlier. Traders sell into rallies. This caps upward movement. Regulatory enforcement adds another layer. Unauthorized trading faces heavy penalties in China. Dealers build compliance costs into pricing. These costs do not exist at the same scale in America. Over time, small differences accumulate. Each layer adds a few dollars. Together, they form the $28 gap. This gap is not created by one event. It is built slowly through systems and behavior. It reflects how two economic models handle the same resource. One emphasizes control and security. The other emphasizes speed and liquidity. Both have advantages. Both create different pricing realities. And those realities shape how investors experience the silver market. Understanding this structure prepares us for what comes next. As we reach the conclusion of this deep dive, it is clear that the 28 gap between China and America is more than just a number. It represents structural differences in supply, demand, policy, and investor behavior. Chinese premiums are unlikely to disappear anytime soon. Industrial demand, government priorities, currency effects, and psychological factors all combine to keep prices elevated. For U.S. investors, this creates both opportunity and a warning. While prices may seem cheaper, global forces can influence domestic markets. Watching Chinese premiums offers a glimpse into future trends. Timing your purchases ahead of surges can be the difference between profit and missed opportunity. Physical silver remains important, but it must be paired with secure storage, proper insurance, and market awareness. For Chinese investors, paying a premium secures immediate access to physical metal. Even if global prices drop, the strategic value of holding silver in hand cannot be overstated. Cross-border arbitrage may seem tempting, but hidden costs and regulatory hurdles make it risky. Shipping, tariffs, storage, and compliance fees quickly reduce potential profits. Instead, understanding market mechanics and acting within your domestic system is often the safer path. ETFs and futures provide U.S. investors with flexibility and liquidity. In China, physical holdings dominate, so strategy must focus on securing supply. Future shocks can widen the gap. Sudden industrial demand, policy changes, or currency fluctuations can create dramatic price swings. Investors prepared for these events can protect their portfolios. Those who ignore them risk being caught off guard. The $28 gap is a living indicator of global silver pressures. It reflects industrial consumption, government strategy, logistics, and human behavior all at once. For global investors, understanding these forces is crucial. Rising Chinese demand inevitably affects U.S. and European prices. Strategic planning, monitoring global trends, and managing risk are essential. Industrial buyers must account for higher Chinese premiums to avoid production disruption. Retail investors must consider timing, storage, and access to physical metal. Long-term strategies may include balancing physical holdings, ETFs, and hedging instruments. Flexibility is key, but so is understanding where supply is concentrated. The gap will not disappear overnight, and attempts to arbitrage without understanding the system are often unprofitable. The lesson is clear. Knowledge and timing matter more than chasing short-term profits. Understanding the interplay of these markets can give investors a real advantage. Those who read the signals from China can anticipate global price shifts before others do. Conversely, ignoring these signals can leave portfolios exposed. The U.S. market may appear stable, but global pressures are always present. Silver is not just a commodity. It is a strategic, industrial, and financial asset. The $28 gap reminds us that global markets are interconnected, and one country's policies can ripple worldwide. Investors who grasp this complexity are better prepared to navigate uncertainty. Now, before we end, a quick reminder. Like this video and subscribe to the Gray Ledger. Turn on notifications to get instant updates on silver, gold, and other critical market insights. Comment below with your predictions. Do you think that China U.S. silver gap will widen or shrink? Share your thoughts with the community. Market discussion improves everyone's understanding. Also, share this video with friends or colleagues interested in investing, precious metals, or global markets. By following the gray ledger, you stay ahead of market shifts and understand the forces shaping silver prices. The story of Chinese premiums versus U.S. pricing is not just about dollars. It is about strategy, timing, insight, and awareness. Every ounce of silver reflects a complex interplay of production, policy, and perception. Understanding these dynamics can change the way you approach investment decisions. The gap is persistent, but it is not static. Future industrial growth, government action, or market shocks can influence it. U.S. investors can use this knowledge to prepare, hedge, and profit intelligently. Chinese investors can understand why paying a premium is often rational and strategic. Global investors benefit by reading the signals early and positioning wisely. The $28 difference is a window into the larger story of global silver markets. It is a story of scarcity, competition, government intervention, industrial demand, and human psychology. By recognizing these forces, investors gain insight that goes far beyond simple pricing charts. And the final takeaway is this: timing, knowledge, and strategy always outperform reactive buying. Markets may appear volatile, but informed action separates opportunity from risk. The $28 gap is both a warning and a guidepost for anyone participating in silver markets. It is a lesson in understanding global systems, not just watching numbers. So remember to like this video if you learned something new. Subscribe to the Gray Ledger for ongoing insights. Comment your thoughts. Will the China premium rise further? Share this video to help others understand the global dynamics shaping silver. The story of U.S. versus Chinese silver pricing is far from over. And by understanding it, you gain an edge in a world where information and timing are everything. Silver is more than metal. It is a lens to view global economics, strategy, and market psychology. Watch, learn, and use this knowledge to navigate the market smarter. The Gray Ledger will continue to uncover these trends for serious investors like you. Stay alert, stay informed, and remember, the gap between $108 and $136 tells a story few truly understand.